Rebecca Cullen. I lead this Grid Charlotte group. Grid is a nationwide investor-focused education networking group. Every month, as most of you know, it talks about the life cycle of investing, and we bring on special guests, like we're going to introduce Kris in just a little bit. And literally from January to December, we have the life cycle. So if there's something specific that you're wanting education in, then you should plug into those events. And we typically host the second Wednesday of each month at 5:30. And usually it's held in person, but because we have great subject matter experts that are not here locally, we have been going virtual these last few episodes. So thanks for being here, everyone. And last, I'm going to introduce Kris. Kris, if you wouldn't mind taking it away, introducing yourself, and we can get started.
Sure. So I'm Kris Wise. I've been a realtor for 22 years. I was an accountant before that. I've been with Keller Williams for the last 15 years. I am part of a national expansion team called Place, and that's a whole nother category. I bought my first rental with my 401k back in 2010 and have taught this class many times locally to our market center. And for a while, it was actually continuing education. So people would take it to get their CE hours. And I just have a passion for real estate and would love to be able to share that with you guys.
We're so glad to have you. Thank you. So, Lisa, is it possible to start the slides?
And if it's not, I can share my screen and do it from here. Let's see.
Yes. She got further than I did. So thanks for that. All right. So we're just going to continue to, so we did that. So I shared our mission. We welcome all experience levels. That's a big thing. No matter what your experience level from an investing standpoint, just send people to that link for the meetups. And if they're not able to come in person, or if they're not able to join virtually, we record these typically, and we send out the recap every single next day. We commit to that. Rania loves when I send her last minute additions to that email. So we do commit to 24 hours after each grid meeting. You can move forward, Lisa. Thank you. We already did this. Great. Thank you. And then important legal stuff. Please consult attorneys. Please consult accountants. Please consult CPAs. What Kris is going to share with you is, based off of continuing education, but please, please, please do your own research for what works for you. And then we will be filming this and we will use it for photography. So hopefully you will release that information for us, and we will get started after this slide. There we go.
Yay! So hopefully it animates. If not, then we'll see. But you're in the right spot if you're thinking, man, I don't want to have my money in the stock market and wake up like a lot of us did in 2009 and 2008 and whatever, and it was worth half of what it was before. And so for a lot of us, real estate, and certainly real estate investing, is something that's near and dear to our heart. And anytime you can get mailbox money, so money coming in to your mailbox, that you could be on vacation, you could be wherever, and have that money come in, that's the best kind of money. I always said that the meaning of life is passive income. The more passive income you can get, I promise your life will be really awesome. So today we're going to be talking about leveraging your 401k. It also can be an IRA. So I'll use those interchangeably, meaning that it's not just a 401k and it's not just an IRA. Both of them are self-directed, and that's what is most important. And it just depends on your situation. So When I say 401k, think IRA or vice versa. So we can go to the next one. There we go. So building your wealth. How are you building your wealth now? So anybody want to unmute and just tell me how you're building your wealth?
Through rental properties.
Okay, awesome.
Just putting more money in the 401k.
Yes. So anybody buying stocks? Anybody buying anything like that? Yeah, I've got some money in stocks. So what's nice is, you know, when you buy a rental property and somebody makes a bad decision somewhere in the government or something like that, it's not worth half of what it was the day before. So I love that aspect when thinking about building your wealth through real estate. Okay, go to the next slide. So what to buy? It sounds like a lot of you already have investment properties, so you understand what your buy box is. And your buy box is no different than what you're normally doing. So you're still worried about cash flow, you're still worried about appreciation, and then of course the rentability if it's something that you're going to be renting, either short-term, long-term, you know, whatever. You're going to be looking at those numbers. Those numbers have not changed just because the source of the funds are in a different location. So keep that in mind. I've always said that when one of my investors I'm working with goes, oh my God, I love that kitchen, we've totally made an investment decision based on emotion, and we should never do that. So don't fall in love with the house. Don't fall in love with the property. Fall in love with the numbers. And if the numbers don't work, don't buy it. And that is 100% true all the time. So the next thing, financial planning. So plan your budget for the property purchase. Are you going to pay cash for it, or do you need a mortgage for that? And we'll talk through getting a non-recourse loan for a mortgage if you need that. And I'll talk to you about what I've done. Renovation costs. So, you know, thinking about acquiring the property and then what are going to be the costs to get it ready to be able to then list it for rent and then get a good rental income. So regulations. So you need to understand what are the rules related to the IRA and 401k investing, because the last thing you'd want to do is to trigger a taxable event for your entire 401k or IRA. The whole reason we're doing this is if it's a Roth, you've done it after tax. If it's a regular one, then you're doing it pre-tax and you're trying to defer your taxes. So the last thing you want to do is to make one little slip up and have either the wrong person renting your house, or maybe you do something to the property yourself and find out that you've just triggered a taxable event, which would not be good. So you've got penalties and interest and all of that stuff. So disallowed parties. So when it is your own 401k or IRA, there are disallowed parties. Those are the people that can't either do work on the property or live in the property. So I think of it this way. It's, so me, I'm a disallowed property or person. The people above me, my parents and grandparents, and the people below me, my kids, are all disallowed. I could never do something with them or have them live in one of my properties. Same thing with my spouse. So if I'm married, then my spouse's parents, grandparents, or kids, if they're not my own kids, cannot ever be involved in that property. My brother can be involved. My cousin can be involved. I was going to say my in-laws, but it's not my in-laws because that would be my spouse. But somebody who's outside of that linear relationship. You do not want to have your child living in the property that you purchased in the college town that your child is going to school in. That could create a taxable event for your property because you have a disallowed person with that. Now, does that make sense? Is there anybody, because this is one of the trip ups that people do, is they let their brother, you know, come in, which their brother would be okay. Gosh, brother's okay, but their parent or their kid live in one of their rental properties. So anybody have any things about that?
If the child had purchased it, let's say through a IRA or something in the future, could they have roommates and it not be a taxable event?
if they're living in the house, it's taxable because it's not an arm's length. So if the child or anybody, so anybody buys a property and has people living in it that are not related to them linearly, then they're okay. But in the case of one that I purchased, I thought that possibly my children would go to the school where I purchased the property. My parents ended up buying the one next door, not with 401k funds. I bought mine with 401k funds, and we said jokingly, well, the kids will live at your house. They won't be living at my house because of that. So now what's nice is, Rebecca, you and I could buy houses next door to each other and then just rent each other's because we're not related. So sometimes people will say, well, I want to have a place on the beach so that I can go and use it, but then rent it out. As soon as you've stepped foot in it and stayed in it, guess what? You have now made it a taxable thing, which, because you're disallowed, you are yourself or somebody who's linear to you. So that's where you partner up. So Rebecca and I partner up and we buy beachfront property in Florida right now. Probably could get it for a really good price. And then we buy them next door to each other, down the street, doesn't matter. But then we would only go into each other's places. We would never be in our own place. So that would be one way to kind of not get past. You're just making it legal. You still get the benefit of being there, but you're not crossing that line. So disallowed investments. So the investments that you're allowed to purchase with a 401k or an IRA are basically anything that is going to be providing income for you, because remember, this is your retirement. So you don't just want to buy something that's not going to do anything, a depreciating asset. But you cannot buy life insurance or collections. So like a stamp collection or coin collection, any kind of collectible items, baseball cards, anything like that cannot be purchased with your 401k or IRA. So what can you purchase? Well, anything that's not a collectible and not life insurance. You want to buy a car wash? You want to buy a car wash? You can do that. You want to buy a fleet of taxis and have that operated as an entity? You can do that. You want to buy a storage building, area that has storage buildings? You can do that as well. You can buy rental properties. You can buy investment properties. You can buy, buildings. You can buy whatever you want as long as it's not a collectible and it's not life insurance. Now, there are nuances with some of those, and that's where you've got to have a trusted advisor. And I at the end, I'll show you who I work with as my trusted advisor to make sure that I'm running any kind of weird plays, against him and say, okay, I'm thinking about doing this. Is that legal? What can I do? And then they are there to guide us, because they don't want you to, have any problems. They want to make sure that you're operating within the banks of the river. I always say, I want to have at least 1 foot wet in the river. 1 foot can be out, but 1 foot needs to at least be within the realm of the law. And I would never encourage anybody to do something that's outside of that. So if it's not a collectible and it's not life insurance, then it is fair game. It just may mean that you need to do some other things, and we'll talk more about that in a moment. And then the last thing is submit your offer. So once you've decided what you're going to buy, then you'll make an offer just like you would make an offer now on any kind of property, except the 401k will be the purchasing entity and you will sign as a trustee. Now that's assuming that you go through the way that I went through it, which is called a checkbook IRA, where I have control of that. There are other companies, Quest is one of those, there's other ones that they will be your trustee, and it's kind of difficult because at that point they've got to be the one that evaluates the properties and they make the offers on the properties, and you're doing it through them. I wanted to be in control, and so the route that I did was the other way you can do it, which is where you do it, where you have a checkbook and you have money sitting in there and you're basically the trustee for that account. And we'll talk through the mechanics of that. But thinking about what to buy, other than those excluded items, and then also the excluded parties, you can buy anything that makes sense. So are there any questions about that at this point? So when you're thinking about properties, a lot of times you think about the cash flow of the property. You're also thinking of appreciation. There may be, part of your strategy might be a buy and hold, and that the cash flow, isn't much, but that long term, if you wait long enough, it's going to have incredible appreciation. And what better way than to have that, either, especially if you buy it in a Roth IRA, have that appreciation not taxable would be great. Okay, let's go to the next slide. So what are the mechanics when you're going to start out? So the first thing you need to do is you have to create your entity. Just like you probably have an LLC or an S Corp, you went to an attorney or some person who does those things, or maybe you went to LegalZoom. I don't recommend you go to LegalZoom for this particular one. Go ahead and go to the person who knows what they're doing. And you need to get the entity created. And I think it's typically about $1,800 to get that set up. And you're going to be creating that entity with the company. The company I use, and it'll be at the end, is Safeguard Financial. So I've been working with Brian Eastman for, since 2010 when I started this. And he was the one that set up the entity. So for those of you who have LLCs, depending on who you get your entity set up through, you get a binder, right? So once you get that binder, then you're ready to do the next thing, which is open your bank account. Now, I'm not going to talk about if you use Quest or one of those trustee organizations where they are the person who's handling your money, because I didn't go that route. That felt to me like it would tie my hands. Not that I needed to be on the courthouse steps with my cashier's checks ready to buy properties like some of my investor friends, but I also felt like going through a trustee every time I wanted to buy something was going to cost me more money. And I really didn't need that. So that's why I did the where I was the custodian. So the next thing is you take your binder and you bring it to your local bank. And you'll probably be in the commercial banking division section, those kind of people. This is not just a typical checking account. They do need to set it up a certain way. And you want to make sure that you're dealing with somebody at the bank who understands this is a self-directed 401k or IRA. And they need to set that up appropriately. So when you are meeting with your bank, just talk to them about that. If they have no experience with that, then I would go back to Brian Eastman at Safeguard Financial, the one who's going to set it up for you, and talk to him about what bank would be an appropriate bank. So I've had them set up Chase, and then also at Wells Fargo, and they knew what they were doing. Was that a question or just somebody happened to unmute? I think it was just an unmute. So now that we've opened the account, or we've set up the entity, open the account, now we got to fund your 401k. And this is where you would roll it over from your existing 401k or IRA. So several of you are in corporate jobs or have been in corporate jobs. I was the same way. And I funded my first 401k with this at, I think, $155,000 that I'd rolled over from my corporate accounting days, and had it in the checkbook. So it's just sitting there. And so that's the best way to do it. You could also contribute money, but then you are limited, and that's going to be between you and your CPA. I don't know what your tax status is and all of that. So you may be able to contribute more if you're self-employed and those kind of things. That's not for me to decide and help you. That would be something that you would be talking to your CPA about what you could fund. But a lot of people do the rollover. So it's just like if you rolled it over from Charles Schwab over to Edward Jones. There is no difference. You are getting the check payable to the benefit of the new 401k that you just opened. You bring it to the bank, you put that into the bank, and now you've got that money sitting there. So the last thing is contracting on the price. Angeline, did you have a question?
Yes, ma'am. So I'm wondering, do I need permission from my employer to roll this money over to the new 401k if I'm
So that's,
still employed with them?
yeah, so that is a great question. Most companies that you are still employed by will not allow you to roll over money out of their plan because they want to have as much money in there as possibly they can have. But you can check. There are times, depending on what your balances are, maybe what your status is within the company, that you could take a piece of that and roll it over to a self-directed IRA or 401k. So that would be something you would just need to check with your plan administrator.
Okay, thank you.
Yeah, you're welcome. So some people actually rolled over several into one so that they have enough money to buy the first property. And so that's something that you can do as well. So then the last thing is, okay, so now you're going to go make an offer on the property and you're going to contract on it. So we've got our money sitting in our checking account. So when we make an offer on a property, depending on what state you're in, there's usually an earnest money deposit. There might be what's called due diligence. It just depends on how your state handles that. But when you're ready to write that check to give to the attorney or the title company, however your state settles properties, you will need to write that from that 401k account, because everything, every expense and every piece of revenue for your 401k needs to flow through that account. So you're paying for the inspection fee, you might be paying for some tests or something like that. All of those have to go through that checking account. If you, yeah, I'm trying to think of anything else that you might pay. If there was any kind of fees, anything like that that's related to acquiring that property, you will pay for that out of that checking account. Now, let's say you get a refund for some reason, maybe you overpaid and you get a refund. That needs to go back into that checking account. Everything needs to go in and out of that account. Because the last thing you want to do is to somehow put money into your pocket and then create a taxable event, which I promise you don't want to do that. So yes, Lisa.
For you. Quick question. So basically you have to have the full amount of what the purchase price is in this account. You couldn't pay for part of it. Like if you only had so much and you wanted a property that was more than that, you couldn't use this and other money you had. You had to would have to have the full amount in this account.
Yes, so that's a great question. So you can get what is called a non-recourse mortgage. There's literally two banks, and I will give you the name of the one I used at the end, North American Savings Bank, that will do a non-recourse 401k or IRA mortgage. Now, non-recourse means that your entity, so your 401k or IRA entity, is the borrower and the house is the collateral. I could be unemployed living under a bridge, but if that entity has enough money and the collateral has enough cash flow to warrant getting a mortgage, I could get a mortgage. So this works really well for self-employed people. Maybe you're asset rich, but not, you don't have income in the traditional sense. But for the most part, they will only loan about 50%. So it's not 5, 10, 20% down, get the rest. It's about 50% down. Yeah, good question. Now, you also hinted at another question, and that is, gosh, could I partner with other people possibly, maybe other 401ks even, and create a partnership, buy into that partnership with my 401k, and then buy the property? And yes, you can. You just need to make sure that you're working with an attorney who understands how to set that up.
Okay. So like if my spouse had a 401k and I had one, we could make a partnership together to then use that money collectively to purchase.
Yes. And I would talk to Brian Eastman at Safeguard Financial. His information will be at the end, and make sure that if he knows going in, that's how it's going to be, then that makes sense. My husband and I we had separate accounts for our money, but we were still the same 401k, and then we would invest that way. But yes, make sure that you've got it set up correctly, because if the account itself needs to be for the benefit of you, And then the other account is for the benefit of your husband.
Okay.
But it would never be commingled. Just like if you're working for Coca-Cola, you don't have access to the CEO's 401k. They don't have access to yours. You have a totally separate account, but it's still the same 401k.
Okay. It looks like Sam has a question as well.
Yes, go ahead.
Thank you very much. So my question is about the timing. So obviously you don't want to fund this account because you don't know how much money you need. You don't want to let the money sit over there because that money is not invested. So what is the transfer time to initiate this transfer from your 401k to this personally managed 401k account, checking account, and then to proceed with the purchase of the property?
Yeah, it's a great question. So that depends on where it's coming from. So if it's coming from a rolled over 401k at Bank of America, then it's just a matter of finding out when I request it through the whatever form that I'm requesting it, how fast can you process that transfer? So it may be that, you don't know until closer to closing how much everything's going to be, and then you transfer it at that time. You'll want it to go directly into your checking account, and then from there go to the title company or however you do the escrow in your state.
So just a quick follow up on that. Can we do multiple transfers? Let's say I get closer to closing and my estimates were off because the taxes for the houses are high. I need to pay the sellers taxes, their share back to them, or some other issue. Can I do a secondary transfer to cover the gap?
Yes, definitely. And I'll tell you, so the first house that I bought, it's in College Station, Texas, where Texas A&M is. And I bought it in 2010. The house was, I think, 155,000, something like that. And I realized I was going to be short a little bit, and I didn't have any more money in my 401k that I could roll it over. And so I talked to my CPA, and I did a contribution to my 401k for that year, and that gave me enough money to then pay cash for the property. So yes, you're not penalized. I mean, other than, potentially at your bank, if it's usually checking accounts will allow unlimited transfers. And so it's not like it's going to cause you a problem. But yeah, you can, as long as everything flows through that account, you are fine. You can do as many as you need to.
Awesome. Thanks.
Yeah. Good questions. Good questions. Let's go to the next slide. Okay. So as I have said, and I'm going to beat it into your head, all the money flows through the account. So you buy the property, you go over there, there's a light bulb burned out. You go to Lowe's or Home Depot, you buy the light bulb, you use your 401k to buy the light bulb. And then now theoretically, you should have a handyman go install that light bulb because you cannot materially participate in your investment. So some people say, oh, it's just a light bulb. Okay, I know, it's just a light bulb. But the last thing you want to do is to have a problem where you've now created a taxable event. So if it's one light bulb, I'm sure the IRS would say, okay, I'm willing to not look at that. But if you're replacing countertops and, putting in a new dishwasher and, other things, it needs to be done by a contractor that's not you. And that's not your parents or your kids. It could be your brother. It could be your cousin. It can be another entity. But it cannot be an excluded party, which would be those people linearly above you or below you, or your spouse above or below. So keep that in mind. It could be your brother, could be your sister, could be an aunt, because they are not in that direct linear relationship. But part of the 401k and IRA investment process is that your investments are always at arm's length. So you want to make sure that you are doing what you need to do to keep it at arm's length, which just reminded me about something that I completely forgot about because we do have realtors on here. You cannot take a commission. You cannot take a commission. If you take a commission on this, you're going to have a problem because therefore you have just now earned money off of the investment that's supposed to be totally arm's length. So you reduce the price by the commission, whatever you need to do, but do not take a commission on this when you buy it, nor when you sell it. Very important. just like I said, arm's length. So you cannot participate. So if it's a rental property, using a property manager is going to be your best bet, because then there's no question that you didn't, you weren't over there doing those things. The property manager took care of everything. And I highly recommend that. When I bought my first property down in College Station, that's what I had, because it was 3 hours away driving. I wasn't going to go down there and change air filters and things like that. And it was student housing. So I wanted people who knew how to deal with student housing. And so the property manager at the time, because I had brought several investors down there buying them, they only charged me 5%. So it was awesome. Usually it's between 8 and 10%. So it was a great way to really help my investors. And several of us bought in this one neighborhood. So also, general contractor, handyman, all of those things, you should be paying a check to a company or to a person to do those particular things, and just make sure it is not somebody who's above you or below you or spouse above and below. So then, just like I said, the disallowed parties, and I'm going to say it until I'm blue in the face, because the last thing I'd want is for you to say, oh yeah, she said something about that, but I don't remember what that was. So my husband did this one thing. No, think about it. I did have my cousin live in one of my properties, and that was fine. He was not disallowed because he was far enough away that it wasn't a problem. But I couldn't let my kids live in there. There's no way, because they're disallowed. Let's go to the next one. So here's some things. So we've got a vacation rental. Is that allowed? Yes. A car wash. Is that allowed? Yes. Storage facility? Yep. And the animation didn't work, but there's a little coin collection. Those coins, you better not. That is a disallowed. You cannot invest in a coin collection. The next one would be like an apartment building. Yes. And then a taxi. As long as you're not driving the taxi, you're good. And then the last one was like, what the heck is that? That's house flipping. So if you were flipping a house, then you can do that within your 401k as well. Remember, you cannot do the work. So if you're one of those people that you're like a DIY, or you just love doing it, you love picking out the things, you love just making it all wonderful, you better step back and have somebody else do that. And you can work through them, but they need to be the ones who are actually, doing the work, and you're paying them to do all of that. Because if you're in there and you're doing it, then potentially you could have created a taxable event, which you don't want to do. So is there anything else you can think of by looking at that graphic? What would you be interested in investing in? What have you thought about investing in?
Hey, Kris, you've got a couple questions for hand raises on here.
I see Angeline.
Yeah.
Yeah. So regarding, you said hiring a property manager, or you can't do the work yourself. What if you own the property management company, or if you own the handyman company? Is that a no-no?
So are you the sole owner?
No, let's say you have partners.
Like how much percent? Because I think there's something about 10%.
Okay, so if you have 3 partners and it's 33, 33, 33.
Yeah.
And you're one of the partners?
Yeah, I would say, just off the top of my head, I would think that would be a disallowed party. I would check with Brian Eastman, because he'd be able to let you know, because he knows the ins and outs of that kind of thing. And I haven't been in that scenario to then be able to tell you, yes, I've checked on that and it's fine. But you're right. I mean, isn't that what we all want, is really to create the total transaction? If we have all the pieces in there, then we're making money in many, many ways, which is great. However, it may preclude you from being able to use 401k or IRA funds by having that.
Right. And just one other quick question regarding the flipping. So are there any nuances that we need to be aware of with flipping? Because I think that when you flip a house, like if you just do it the traditional way, you have to pay short-term capital gains, right?
Right.
So if you're doing it in your 401k or your IRA, that rule does not apply?
No, so the capital gains are deferred.
Oh,
Yes.
okay. Thank you.
Yeah. Yes.
Yeah, so
it's deferred.
flipping is considered income. So that's why what's the right word? If your intention is to do 1031, kick the can down the road, you cannot do 1031ing with flipping because it's a taxable, it's like income. So this is your way around it, which is what Kris.
Okay. Yes. Yes. Okay.
Yeah.
Good. Thank
Yeah,
you.
and if you do it with the Roth, then it's tax-free.
Right.
Right.
Just
you do
just
it with the-
remember that you're paying all contractors out of the 401k checking
Yes.
account.
Mm-hmm.
Yes. Everything. Everything. Yeah. Do we
So
have
just
another hand?
just a quick add-on question to that. So I'm actually currently working on a home renovation project, and my contractor is asking me to supply the materials. So it would be okay as long as all the money for that project comes from the checking account, to the point where it would have to be some type of debit card paying at Home Depot. I couldn't use a personal credit card and transfer the money to that credit card.
Nope. Yeah, it needs, and that's what I had. I had a credit card from my 401k account. And anytime that I had to go to Home Depot or anything like that, I would use that card. Now, you concerned me. So who's the home renovation for?
So this is actually a home that I already own, and I'm renovating the house. It's just older home, needed some work,
Okay, well, if it
and
wasn't,
I'm renovating it to rent it out.
okay, if it wasn't purchased in your 401k originally, you can't, I mean, there's probably a creative way that you could create a partnership that the 401k does something. But if you already own the property and then you want to somehow convert it into a 401k, you can't, because you are an excluded party. And so you couldn't sell it to your 401k.
Right, right. That's not the context in which I was asking. I was
Okay.
using the example as a reference for future. If I want to flip, let's say I find a contractor and he say, "Hey, I'll do the work, you supply the materials." So I was just asking about the material purchase aspect.
Yes. And that's great. So yeah, you can definitely do that without any trouble. Yep. Jeff.
So if I'm thinking of this correctly, you're becoming the plan administrator of your own 401k rather than Fidelity or these big banks, right?
Exactly.
And you cannot benefit as the plan administrator, even though eventually you will be the beneficiary of this fund. Is that what I'm understanding? You cannot profit from it, or you're basically the fiduciary of your own funds, but you can't have these ancillary businesses to do
Yes.
that.
You
Is
are
that-
the trustee and you are right. You
Okay.
cannot benefit. The 401k has to benefit. So, and I mean, just sitting here thinking about it, I do not believe that a 401k can own a property management company. That's too convoluted for what this would be for. And you just don't want to, I mean, we can try to get all creative, but like I said, I like to have at least 1 foot in the river when I have the banks of the river. And that just gets so far out on the edge that I wouldn't feel comfortable. But Brian Eastman would be the person to talk to when, if it's 2 o'clock in the morning and you're like, wow, I could do this, write it down or send him an email and then see if it's doable. But yeah, no, you're thinking correctly.
So then the follow-up to that would be, let's say we buy a $200,000 property and then we sell it for $4, let's just say that's all profit, including expenses. That money's going back into the 401k and it's a profit from a piece of real estate rather than a Target stock or a NVIDIA stock, or so it's growing tax-free, depending on if it's Roth or not, obviously, but you're basically, you're picking your own bets inside of this 401k as it relates to real estate rather than the stock market. Do I have that kind of correct, or at least the general direction?
You have it 100% correct. So I used to say, if it's Coca-Cola, you sold Coca-Cola stock and you bought Pepsi stock. It's all going to go through your account if it's within your 401k. In this case, you're selling your Coca-Cola stock and you're buying 123 Main Street. And so it does not change anything. This was a normal investment. So just like when Coca-Cola pays you a dividend, that's like your rent. That goes into your account and you reinvest. Well, if you just have 1 month's rent payment, you don't have much money sitting in your account, right? But over time, and that's what happened with me after I bought my first house, was I then had money sitting in the account because I had paid cash and the rent was a good rate. So then I was like, what am I going to do with this money? Because I don't want it just sitting there. But also, I wasn't, excited about the stock market at that time. That was 2010 and 2011. So what I ended up doing was I said, this first investment's been so great. Now I'm going to get a mortgage for 50% and I'm going to buy a second one. So the old lather, rinse, repeat, that's what I wanted to do. And so I got a 50% mortgage on the first one, bought the second one. Now I had 2 horses in the race that were generating cash. Now, even though I had mortgage payments, I still had a decent amount of cash. I was sitting with $50,000, $75,000 in my account. I then moved into a flipping partnership and I bought a share or shares of that flipping partnership with my 401k. It was all arm's length. I was not related to the person who was the main person on that. And we did that for many years. And that was my way of getting the rent payments that would be, like $50,000 after several months. I was able to then deploy that into the market because at that time, you think about, 2011, 2012, 2013, great flipping time. The market was coming back finally, and there were still good deals to be gotten. So then I got into that and started doing that with that money.
Thank you. That's great. Just one last thing. I looked into doing a uni 401k and the fees were pretty high. I know everything's different and you can't quote fees, but are these relatively low compared to some of the things that I've looked at?
Yeah. So I think it's $1,800 to get the entity set up. And then it's $125 a year to maintain the plan. And that's it.
Wow. That's great. Okay.
Yeah. So you're not, when you do those like Quest and those other ones where they're the trustee, you're just the person who's funding it, they'll charge you every time you buy something, every time you sell something, there's fees associated with that. I like having that checkbook control. Now you also have to be, disciplined because once your account or the value gets over, I think it's 250,000, you do need to file what's called a 5500 EZ, which is just an informational return that says how much your 401k or IRA is worth. And I did not do that for a number of years because honestly, I had forgotten. Mm-hmm. And so then I had to pay a nice penalty because they went back to when the thing started and said, this is when you hit your 250,000. Here's all the years. And I think it ended up being $1,500. So yeah, don't do that. Make sure that you do what you're supposed to do.
This is fantastic. Thank you for the information. Appreciate it.
You're welcome.
Sam, you're up. Yeah.
Yeah, so I just had one more follow-up. Sorry, there's good discussion, so my brain is churning over here.
Oh, I love that. It shouldn't be lectures, it should be interactive.
So my latest question is, so I'm already at the point where my 401k will put me, even if I don't contribute any more to it, it'll put me into the highest tax bracket when I retire. Yeah. This is only going to accelerate it further. So I'm already looking at converting it into Roth right now. So I'm actually meeting with the accountant next week to figure that out. So two-part question. First, I'm making profit on this money. Let's say I do a long-term rental. I've got tenants in there, they're paying rent. There's money going back into this 401k checking account. Can I convert that to Roth directly through there, or do I need to transfer it to do a conversion? Second part of the question. Go ahead, answer the first one.
You can convert it.
Okay. All right. So second part of the question, the IRA, the Roth limit of the $150,000. That's if I'm above that mark with my rental income and my job income, this would all have to be like the backdoor Roth, right?
That's going to be between you and your CPA.
Understood. Thank you.
Yep. Now you can convert but you're talking about contributing. So converting is how much tax do you have that you're able to pay when you convert? The best way to convert is to convert that cash because there's no dispute about how much it's worth at that point. So if you said, okay, I'm going to take 25,000 sitting in my account, I'm going to convert it to a Roth 401k. You do the magic paperwork and it's now magically a Roth, then that's fine. And Brian Eastman will be the one who can talk you through that because the entity that he creates also has a Roth provision. So you don't have to, it's already in there. So it's just a matter of accounting for it correctly.
Okay, perfect. Thank you.
No, that's great. That's great. Let's see what our next slide is. I'm trying to remember what, there we go. Okay. As if on cue. So definitely take a picture of this. Brian Eastman and also their website, IRA123.com is very helpful. And he took a call from me on a Friday afternoon, the day that the 5500 EZ was due. And I said, Brian, I just remembered because somebody asked me about it. I just remember I'm supposed to do this. What do I do? And he walked me through it. So he is awesome and highly recommend him for sure. He can get that set up for you. And then if you say Kris Wise, I think he gives you a little bit of a discount. I don't know how much that is, but that might help you a little bit. And then North American Savings Bank is one of two, and I don't even remember what the other bank is, but one of two banks in the United States that will do what's called a non-recourse 401k or IRA mortgage. And that's how I funded my second property, was going through that. Now, the interest rate at the time, interest rate for regular investment property was probably 3%. I ended up having to pay like 6.5% because it's non-recourse. So they're only going after the 401k. They would never come after me personally if I stopped making payments. So, so the interest rate is higher. I don't know what, I haven't had one of their mortgages in a number of years, so I don't know what they are right now, but they are really good for, you know, there's a great worksheet that you can fill out, and then they'll tell you based on that what they're willing to lend. And it's anywhere between 40 and 60% that they're willing to lend on that. So yeah, very good there. Let's see what the last, I think it's just my contact. Yes. So this is going to sound crazy, but I sold my last rental property. My cousin was living in it, and I sold my last one earlier this year, and I am out of the rental race right now. I do have money in apartment syndication because for me, just my life and where I was at in my career, I just felt like rentals for me were not going to be where it was going to be. It was too much hands-on, and I'm growing a real estate team and doing things like that. So I decided to sell. So it's kind of funny for me to sit here and talk to you about rental properties, knowing that I sold my last one, and I was very happy on the day that I sold it. But I did go through this process, and for 14 years with doing everything within my 401k, and it's grown exponentially. I mean, I'm just truly amazed at what started out as 150,000 is quite a bit more, and it's neat to see it grow. So what other questions do you have?
Now's your time. Y'all feel confident in this?
I have a question.
Yes.
Right. You mentioned needing to open up a bank and an LLC and et cetera. The bank account is if you choose the type of self-directed IRA where you control the money and you have the checkbook, correct?
Yeah.
Right.
Yeah.
Otherwise that company will control the money, right?
Yes.
And is the reason if you do the one that you control the money, the reason why you need to open up that entity, kind of, you mentioned LegalZoom, whatever the places are, right? You in order to open up that is because it's going to be a business. It's going to be considered a business bank account. So that's why you need like the tax ID and the business bank is like, right? Is that correct?
No, you need to set up the 401k entity.
Okay. So but like if you're rolling it over, I need to. Like I would contact that guy that you've been talking about, right?
Mhm.
And you can't just like transfer it over to that. You need a business entity in order to do that. Is that just
Right.
like a single owner LLC, or is there something special because it's because it's tied to this 401k or IRA?
It's a 401k. So you've got to set up the 401k with somebody who knows what they're doing. And I recommend Brian Eastman, because if you don't have the entity bucket to roll that money into, you've just rolled it into a personal account.
I misunderstood. So when you said entity, I thought you meant like an LLC or an S corp, something like that. You meant to open a 401k entity.
Yes.
Got it. Okay.
Yeah.
And then
It's got to be a
okay,
401k
no, that makes
or
sense.
IRA.
Okay, and then my very last question is: you've been talking about all of the money needs to come out from this check. So I'm assuming that you can't get a credit card for this business and use it, and then use one check to always pay off that one credit card for that balance. Everything that comes out of there needs to be out of that checkbook for that.
And you can do a credit card out of that account. And I had one that had my name and then had my 401k name below it, just like a business check or
Okay.
a business credit card. And so then I would swipe and then I would just transfer the money each month to pay that off. Yeah.
Okay, as opposed to like just
Don't ever use a personal.
right. Just from like ease of paying some things versus sending a check. Okay, thank you.
Yeah, because I can tell you, I had a check at Home Depot and it was like some 23-year-old kid. And I think that might have been the first check he's ever seen in his life. He didn't know how to process it.
Right,
So
and then have to carry a
you gotta
check.
throw them
Have to
off
carry a
and-
check around with you all the time. Okay,
Check.
thank you.
Yes, you're very welcome.
I
Other
think,
questions?
so Bella Grace, but I think that's Tanya.
Yeah, I need to change that, and I only see it when I go on these calls. So my question is, so let's say I pass and I have all my assets in a trust. How does that go with that 401k that is now it's really a different entity? Do I need to be careful with that? Should I put it in a trust or keep it
That's-
separate?
Yeah, so that would be just like your other 401ks. So do you have your other 401ks in that same trust?
Yeah, I mean, there is, I'm in the process of setting that up right now, and it really depends on what the beneficiary is doing with like a prenup and stuff if he gets married. So it's like if he does have a prenup, then I will put it in the trust. No, other way. If he has a prenup, I would leave it out because the tax indications are different for him. But if he doesn't have a prenup, then I would put him in the trust. So does that make any difference when you have these investments?
So that's not related to the 401k itself. That would be how your trust is set up. So
Okay.
the attorney who's setting up your trust, just like if you had a Coca-Cola 401k because you worked for Coca-Cola for 20 years, it's
Right.
that same thing. So it's just another 401k that's
Okay.
out there. So if you can put that into the trust, then you can put it into the trust. If you can't, then you can't. It doesn't make a difference on the way this 401k is set up. It's just like
Okay.
every other 401k.
All right, thank you.
Yeah, you're welcome.
And then it looks like we have Sam again.
Oh, yes.
All right. Sorry, I'm a repeat offender over here.
That's okay.
So this is going to be slightly complicated. Rebecca knows this background. So a lot of the rental properties I have, they're shared with my mother. So with the intention that this will be retirement income for her. When she passes, they just automatically transfer into my name. So
Right.
this is a little bit different. But so let's say we buy a property together. We both contribute through our 401k into this, and we move forward together. When she retires, I think there's a rule: if you're not actively working, if you do not have a salaried income, you cannot contribute into your 401k. So how would this work if you are retired?
So retiring has a couple of nuances. So if there's no need to put any more money in because the rental property is taking care of itself and you're not having to fund it, then that's not the problem. Where the problem does come up is when you have to take that required minimum distribution. So let's say, depending on what her calculation is, there is an amount that she has to take, and all of us will have to take it when we get to that age, whatever that age is, a required minimum distribution. So let's say that it's, I don't know, $100,000 in a year, but your rental income is only $90,000 for that year. Where are you going to get the other $10,000? So then several of my friends who are now in their 60s have said, gosh, it looks like I might have to start selling properties to be able to fund my required minimum distribution. And so that's something you want to look at is with your tax advisor looking ahead is at what point will I need to take a required minimum distribution, and will I have properties in the amount? Do I have enough rental income that I can just take that and not have to convert any properties to cash? Or am I going to have to start selling properties at that point to be able to take the required minimum distribution? Now, keep in mind, you sell 123 Main Street for $200,000, but you only were required to take $100,000. That other $100,000 can be used for investments. It's not like you have to take the whole thing, but you may have to sell a property in order to take your required minimum distribution.
Right. So follow up on that required minimum distribution. So that minimum distribution is, I think, currently at 4% at 72 years of age, based on 4% of the value of your 401k. So what is the valuation for the properties? Is it current market value? And who determines the market value? Or is it based on the purchase price?
No, it's always going to be the current market value. Just like your Coca-Cola stock, you might have bought it for 10, but it's now worth 100. So the market value is 100. And you'll be referencing that on your 5500 EZ that you both would be filling out each year to show what the value of the properties are at that point. And I typically just look at January 1st and say, oh, it's about 400,000, or oh, it's 200,000, whatever it is, and put those in for my informational return on the 5500 EZ.
So what would be our mechanism to determine the value for the property? Would that be like just look at what the bank values it as, or Zillow? Or I know Zillow is a bad word in realtor world.
Okay. Yeah, your local realtor can help you with that. If you wanted to always use the Zestimate and just use that every year, so that, I mean, realtors don't like the Zestimate because it doesn't take into account so much market data that is actually a factor in the market. So that's why a lot of realtors don't like the Zestimate. But if you're looking for, okay, how am I going to value this? You'd probably want to look at some online value of something. Is it your property tax rate value? That assessment. Is it what the realtors told you? You can certainly get that. Zestimate, whatever you want to use to create that value.
Okay, thank you.
Yeah, you're welcome. I would just stay consistent on that. So if it's always the Zestimate, then always the Zestimate. If it's the Zestimate for the first 4 years and then the Zestimate gets way out of whack, and then you want to use something else, then talk to your realtor. Some, I know, like I'm in Texas, so the property tax, it shows kind of like the AVM of what it's probably worth. So that would be something you could use too. As long as it's a third party and not just, I think it's worth this, then you can say, well, here's where I got that value. And I think that would be appropriate.
So if you don't mind, just a quick follow-up on that. So we discussed the minimum distribution, but if you have a rental property, every month when the rent comes, you're contributing to your 401k.
No, it's not.
No, that's just growth. That's actually not contributing.
Yeah, it's just like just like your dividend payment.
Right, got it. All right, I answered. Thank you.
Yep. Yeah, so the rent's going in there. And some people will say, well, gosh, I want to start taking distributions. Well, you could take that rent. I would always have it go through the account, and then you take a distribution from that and pay yourself. And then that would be your income from it. And if it's a Roth and you're eligible to take it tax-free, then it would be tax-free. If it's a traditional IRA 401k, then you will have to recognize that as income at that point, at the tax bracket that you're in.
What other questions do y'all have?
So just one quick comment. Everybody's always talking about rolling their money into their current employer. That's probably not a good idea, right? Just keep your 401k with your current employer, and all that old money, roll that into something like this. I mean, that's kind of a good cocktail party conversation, to be honest with you, to get people thinking about different investment avenues.
Yeah, and I can't remember who asked, but the rolling or the current employer, you're right, Jeff. If I rolled in $100,000 to my current employer and now I'm contributing my 6% or whatever, in most plans, that $100,000 that I rolled in, I could roll out. It's only what I'm currently contributing.
Okay.
So if you have rolled it into your current employer, check, of course, but for the most part, you should be able to roll that out and you could pull that out. But a lot of times, if somebody's been with their employer for a long time, they may have reached a threshold where part of that money can be self-directed and rolled out. But a lot of times it's not. They're like, nope, we want to keep that.
Yeah, you just want to give yourself the most options possible. So
Exactly. Yep. I sat in cash for almost a year before I bought my first property in my 401k because, as a Keller Williams agent, I listened to Gary Keller in 2009. And I was like, I called my Edward Jones person and I said, I have a feeling based on what Gary said, I think I need to be in cash. And he says, I can get you to cash by Monday. And I'm like, okay. And I sat in cash. And then it was a couple months later, he's like, I don't know how you did it, Kris, but you timed it perfectly. And I was like, hey, I just followed the master on that one. So
What do they say? You can't time the market, and somehow you and Gary did.
yes. Well, you know what? You listen, and good realtors are that way. They can read the tea leaves and kind of get a feel. And I sold my personal home 2 years ago, literally the hour the market peaked. And it was because of looking at the data and listening to what experts were saying and putting it on the market at that time. And so yes, but do I do that every time? No. The house that my cousin lived in, I sold it for a $60,000 loss. So not one of my best things. Now it was in my 401k, so I don't get to take that $60,000 loss. So that's one thing. You're not having to pay it on the gains, but you're also not getting to take the deductions. You don't get to take the property tax or anything like that. Of course, you're going to pay all of that out of the 401k checkbook, but there's no deduction because it's just a moving balance of what the value is. So it's not, all the details in there.
Great. Well, if there's no other questions, Kris, we're so grateful that you joined us today, and we will be sure to get this out to everyone who joined us. Thank you for including your email addresses to make sure if you didn't register, you'll get the slides. And please connect with Kris if you have any additional questions. What is that? Dallas, Texas, right? DFW?
Yep.
Dallas,
DFW.
Fort Worth.
Mm-hmm.
So if you have any referrals, then make sure you connect with her there.
Would love to earn your referrals.
Brittany just asked, how do you join Grid? So make sure that you go to the meetup, and we will share, if you give us your email address, we'll share. There you go. Grid Charlotte meetup. This is why I love having Rania on here. So just join that link and you'll be receiving emails when we have the next batch of events. Sometimes we have fun like in between slides that go out or information that goes out, but most of the time it's regarding our education. So again, Kris, gratitude shared here. I hope everyone stays safe and has a wonderful rest of their week.
Yes, safe. And to you, I've been following, just what you're going through, and wow.
Well, I'm not going through anything. I'm just grateful to be able to deploy for all my friends who are. So we're just bracing ourselves for Milton as well. And last time I said that, someone showed up naked on the screen. So I will not say that again. But
Was his name
everyone,
Milton?
it was, and that's why I said what I said. So everyone be safe, and if you have any questions, you all know how to reach me too. Thanks. Bye, everyone.